Introduction to the statement of cash flows. What would you need a statement for cash flows for? Let's take a simple example. A taxi driver paid $70, that is all what he had in his pocket, to fill his car with gas at a gas station at the beginning of the day. He worked the whole day and collected $300 from customers. At the end of the day, the taxi driver had paid cash expenses of $70 for gas and collected $300 of cash revenues. So the net cash flow is the net of cash revenue minus cash expenses in this day, which is equal to $230. The taxi driver believes that he had made a profit of $230 this day. However, he met his accountant friend who told him that he is wrong. The accountant explained that there are other expenses that are not paid in cash but are still expenses, such as depreciation expense. The accountant calculated the depreciation expense for the vehicle to be $50, and hence the net income is $180. There could also be expenses that are not paid in cash but are still expenses in the accrual basis of accounting but not in the cash basis. For example, the taxi driver might have washed the car at the end of the day at a friend's shop and promised to pay her later. Another example is that a regular customer forgot his wallet and the taxi driver agreed to pass by tomorrow to collect the money. This is regarded as revenues in the accrual basis but not in the cash basis. Accrual accounting uses lots of estimates while calculating net income. For example, bad debt expense is an expense that is deducted from net income, while it is based on an estimate. Depreciation of long-term assets is based on estimates. Both the asset's useful life and its residual value are estimated. Cost of goods sold is based on a cost flow assumption. So if the inventory costing method changed, both the cost of goods sold and the net income might also change. There are many other assumptions and estimates in accounting for both revenues and expenses. Usually investors and managers are interested to know the cash flows to assess the quality of the net income. If net income is $1,000 and it boils down to only $200 in your cash box, it could be regarded as low quality income. While if there were $900 in the cash box, it would be regarded as high quality income. Benefits of using the statement of cash flows. It shows liquidity and solvency. It helps in predicting cash flows. And it explains the difference between net income, which is based on the accrual basis, and the cash balance, which the company owes. What is included in the statement of cash flows? Always remember that only cash and cash equivalents are included in the statement of cash flows. All currencies are cash and are included. Cash equivalents are assets that can be readily transferred into cash, since there is a ready market to sell them, such as gold, silver, and government treasury bills. Non-cash items are not included. So depreciation, which is a non-cash expense, is excluded. Transactions related to buying or selling on account, involving account receivables and payables, are not included. The statement of cash flows is divided into three main sections: cash flows from operating activities, investing activities, and financing activities. Cash flows from operating activities. All cash related to operations, whether collected or dispersed, is included in the section of the statement of cash flows. Example of cash inflows include cash sales, collection from customers, which is accounts receivable, advance collection of revenue, which is prepaid revenue, etc. Examples of cash outflows related to operating activities include paying of expenses, paying suppliers, accounts payable, incurring prepaid expenses, etc. Cash flows from investing activities. Investments are related to investing in long-term assets, investing in other companies, or providing loans. All cash that is related to investments, whether collected or dispersed, is included in this section of the statement of cash flows. Example of cash inflows include selling of long-term assets, selling of stocks of other companies, selling bonds of other companies, etc. Example of cash outflows include buying long-term assets, buying stocks of other companies, and buying bonds of other companies, etc. Cash flows from financing activities. Financing activities are related to matters related to the raising and paying back of capital and loans. All cash related to financing, whether collected or dispersed, is included in this section of the statement of cash flows. Example of cash inflows include issuing of shares, issuing of bonds, receiving loans, etc. Example of cash outflows include buying back shares, which are treasury shares, redemption of bonds, paying back loans, etc. The cash outflows is subtracted from the cash inflows for each activity to get the net cash generated or used by this activity. By adding the cash generated or used by each activity, we get the total cash generated or used by all activities. By adding the cash generated or used by all activities to the cash balance at the beginning of the period, we get the cash balance that the business has at the end of the period. It should match the cash balance which appears on the statement of financial position.